Hi, I'm Tom Mihawk, and this is Alternative Investment Basics. This series of videos has been produced to shorten the amount of time it takes to get through the videos on investment fundamentals, stocks, bonds. Last one was mutual funds, and this one is alternative investments. The earlier ones I did, there are maybe 2 videos, sometimes 3. There's going to be 1, and this should be about 10 minutes. I will also include the slides and the notes at YouTube, so you can look for them there. You can print them, take notes, whatever you like to do that works. So what are alternative investments? They're generally viewed as an investment in non-traditional securities, like not in stocks, not in bonds, not in cash. Sometimes those with short positions where you're selling first high and buying back later low, right? Long is where you buy first low and sell later high. Short is when you sell first high and buy back later low. More specifically, it might be real assets, including real estate or commodities or natural resources, hedge funds, private equity, including venture capital, structured products, and also as a slide, also in this video is a slide on cryptocurrency and NFTs. All right. Why invest in alternatives? Look at this chart at the bottom. It shows the correlation between 2 quantities, right? So this is looking in particular at automobiles, just as an example, right? So notice that when the auto mileage is higher, the auto value is less. When the auto mileage is lower, the auto value is greater. Notice, and so there's a correlation. It's a negative correlation. As mileage goes up, value goes down, negative. With auto body color, there's no correlation. Blue, red, black, doesn't affect the price at all. There's a positive correlation when the when the auto accidents go up, so this way, auto accidents go up, auto insurance cost goes up. A positive correlation between accidents and insurance. Alternatives give you uncorrelated returns to stocks and bonds. When the economy is bad and stocks are going down, alternative investments may go up in value. So they provide an important diversifying influence, potentially reducing risk and enhancing returns. There's a potential higher return too over traditional securities. Now, there may be more risk. Remember, we talked earlier in investment basics how risk and return are related. So there may be higher risk. Now they're increasingly available to a wider range of investors. Used to be only accredited investors, affluent people could get access to these alternatives. Now more people have access. And that's, well, you could argue, affluent people maybe have more experience with them, but for people who do their research and learn about them, it's a better thing for everyone to have access to them. Real estate can be purchased, owned, you can be leased. The categories are residential, commercial, industrial, owning land, all those. You can be a direct investor, meaning you own the property yourself, like your home, right? Direct, it's a direct real estate investment. Or active, you own the property directly. It could be indirect or passive, where you're investing in an entity like a mutual fund or real estate investment trust that invests in real estate. Now, it's not a non sequitur, but I think it's valuable because it was in my first presentation, the longer one. Think about it. Is my home an asset or an investment? You live there, so it's simply like an asset, like a car, furniture, a boat. Maybe it's not an investment, right? But you want it to appreciate in value, so therefore it's an investment, right? Home ownership offers deductibility of your mortgage interest, a potential hedge against inflation. You live in it, you relax in it, you eat in it, you bathe in it, your personal hygiene. The value of your home is affected by your geography, where you live relative to cities or oceans or lakes or public transportation. Its location near a big city, right? And the situation, is it a single family home, a condominium, the top or bottom of a high rise? All these things affect value. There are beneficial opportunities in real estate that aren't available in all investments, such as leverage. Most people buy a home, they don't pay for it with cash. If they buy a $400,000 home, they might probably borrow $320,000 and put $80,000 down in cash, their down payment, right? This leverage gives more people an opportunity to get into the home. It's facilitated also by the fact that most mortgages, the borrowing, is collateralized by the value, by the home. So if you don't make your payments, after a while, the lender, the bank, takes away the home, which is not good, but that makes possible for lower rates and makes the loan safer. There are tax benefits, such as the deductibility of mortgage interest, depreciation on some investments, and other expenses. And the tax benefits are limited to the income received. But for people who specialize in real estate investments, they understand how to use the tax laws to benefit their investment. The average homeowner can deduct certain things like energy saving equipment and things like that, and their mortgage interest. Real estate investment entities include real estate investment trusts that are companies that own or finance income producing real estate. They have to meet certain requirements. They trade on major stock exchanges. A share of the income produced without having to buy, manage, or finance properties. There are mutual funds, private equity funds, limited partnerships, and syndicates. All of these entities invest in real estate and make exposure to real estate assets available to investors. Why invest in real estate? Diversification. Returns are not correlated with stocks and bonds and other more common investment assets. The tax benefits I mentioned just a moment ago. Leverage is common and may enhance returns. If you invest $80,000 in a $400,000 home and your home goes up by 10%, it's now worth $440,000. You've invested $80,000 and yet your equity has now gone to $120,000 based on a 10% increase in the value of the home. Also has income opportunities and appreciation in value opportunities. I showed this slide in the investment fundamentals video, I think, basics. And this is the cover and one of the early pages in the Yale Endowment newsletter. And it just shows that the Yale Endowment pioneered this style of investing, pioneered by David Swensen, who's now deceased, passed last summer, but pioneered this brand new investing style. It used to be that endowments invested only in stocks and U.S. stocks and U.S. bonds and some cash. Well, now they invest, notice Yale's endowment invests in absolute return, domestic equity, which is U.S. stocks, fixed income, foreign equity, leverage buyouts, all these things that produce diversification and returns across a broad variety of market situations. Let's take a look at private equity, venture capital, and hedge funds. Well, the PowerPoint software limits me, but private equity, I can look at the slides. Private equity invests in privately owned companies. Your opportunity is to grow those companies. You receive returns when those companies are taken public or when they're sold. In general, you commit, just like in venture capital, you commit, your capital is called, it's invested, and it's returned to you in distributions. A good return would be 20% or greater, and fees are high, typically like this, 2% on commitments and 20% on profits. Generally for accredited investors, venture capital invests in, so private equity invests in older companies typically, profitable, maybe not always profitable, but producing revenue generally. Venture capital invests in brand new companies. Some venture-backed companies that you may know, Google, Facebook, Netflix, Uber, Apple, Twitter, right? Good returns would be 20% or greater. Fee structure similar, 2% on commitments, 20% on profits. They invest in new companies, companies that are just developing, right? Just starting, and ones that are a little bit older. My daughter works in a venture capital-backed company. It's 10 years old. It's raised Series C or D now. It's fourth or fifth round of investment. And then hedge funds. Hedge funds are effectively unregulated, have wide latitude in what they can invest in, tend to have low correlation to traditional market indices, invest in foreign securities, invest long and short. They could be event-driven, meaning based on merger and acquisition activity, Fees are typically high, 2% on commitments and 20% on profits. They're generally for accredited investors. Then there are real assets like real estate we talked about before. Return expectations can vary from maybe 5 to 20% depending on what's invested in. Gold has inherent value. The gold itself is valuable. A share of stock is just a piece of paper, right? It's a representation of equity interest, but gold has real value. Gold, by the way, have you ever held it? It's very heavy. You know, it has a beautiful shine and it's very heavy. Its advantage is that its use is that as an inflation hedge, that when the world becomes riskier and there's more volatility, that the gold, the metal itself, and silver, the metal itself has value itself, and it retains that value despite what's happening in the world. Collectibles are things like automobiles, gemstones, artwork. You want to be a pro. Make sure you know your market. I had a client that once said that, and he had a collection of memorabilia from a particular area in Pennsylvania. He had a collection of presidential portraits, these huge, some 10 by 10 portraits. And he said, you know, a collection is worth more than individual pieces. Although he was, when I saw him in Palm Beach, Florida, he was trying to sell an individual piece. You have to know there's a market for your collection and be active in that area. Collection can be right for the right person who's knowledgeable. Now, cryptocurrency and NFTs. Cryptocurrency is the encrypted form of digital currency. It uses blockchain technology and is independent of governments and financial institutions to verify transactions and make payments. This is what people like. It's not subject to the movements of central banks, of financial institutions. Examples are Bitcoin, Ethereum, Litecoin. NFTs are called non-fungible tokens, or are non-fungible tokens. A fungible token is cryptocurrency. It's fungible. One can replace another, but these non-fungible tokens, or NFTs, are things like art, collectibles, and you can use a digital ledger like blockchain technology to mark a particular kind of artwork or particular kind of unique one-of-a-kind item, and that can be tracked and the value ascribed to that item itself. Blockchain is a technology database with attributes that are not individually unique but collectively produce breakthrough approaches in how digital information is stored, verified, and exchanged. It's the blockchain. I don't know what's going to happen with digital currencies, cryptocurrencies. Some I think are going to be valuable long term. Bitcoin, Ethereum are more likely. They're older, they're more mature. Some of the smaller and newer ones I don't know. But I think that there's value in the blockchain, this idea of a digital ledger that can ascribe value to a particular item, that give the chance for a music publisher, for example, to receive payment directly on what they produce and not have to go through other companies to get payment. Why invest in alternatives? Well, they're uncorrelated. Their performance is uncorrelated. Like I said in the very beginning, the color of the car doesn't have any influence on its value, right? But its mileage does. The number of accidents have a implication, have correlation, potentially reducing risk and enhancing returns. There's a potential for higher returns than traditional securities, but they're not guaranteed. So they're usually accompanied by greater risk. Fees are generally higher. Now it's increasingly available to a wider range of investors, not just affluent, accredited investors. It can be less liquid than more common investors. You may have to, common investments, may have to wait longer to get your value. Expertise is helpful, certainly with collectibles, but not always necessary. Know your investments though. Prepare in advance. Learn about potential, return potential, and the risk. This has been Alternative Investment Basics. I'm Tom Mihawk, and this is part of my short series on mutual funds, investment fundamentals, stocks, bonds, and this has been Alternative Investments. Thanks for watching.